A Bay Street analyst has downgraded his rating on Canadian banks RBC and TD Bank to hold. This means he now has no buy ratings on any of the Canadian bank stocks. Let's get more on this from the man himself, John Aiken, research analyst at Jefferies. John, thanks very much for joining us.
My pleasure. Thank you for having me.
Let's start to talk about the individual banks first. RBC, what brought about the change?
Well, it actually is the same reason for both. We do think the valuations are fully reflective of the outlook, and basically we do think that the dynamics are that if there's any ripple on credit, there's more downside risk than upside. Royal, we still really like the fundamentals of the bank. It's well diversified, it's best in class, and but right now is that as we've seen over the fall, over the last 3 months, that it's really being bid up to a point that we think that the valuations are a bit stretched at this stage in the game. Like Royal is at or just within its peak PE multiple on a forward basis, and so basically, we see a little bit of upside in terms of if they report a strong fourth quarter, but to generate another 10-15% will be very difficult unless there's any major change in the macroeconomic outlook.
Now the earnings are coming out next week. Why not wait till then and see the earnings first?
Well, we think that the fourth quarter earnings are going to be solid, but realistically, the areas that they're likely to basically have some tailwinds in terms of strong capital markets, strong wealth management, it's very well understood in the marketplace, and we think that it is priced in. Where the downside risk could exist is on credit, although we don't think it's necessarily going to be weak in the fourth quarter, but also expenses usually tick up in the fourth quarter. When we take a look at the balance of probability, as also where the valuation is, we can't recommend investors going into Royal at this stage of the game because we do see limited upside. We do see a positive, but it's not 15-20%.
And with credit, you mentioned concerns with credit. How big a concern? Where are you looking with that?
In the fourth quarter, not that much. We haven't seen that much disruption in the economy. We've only seen unemployment levels tick up a little bit. So we do think that the provisions relating to impaired loans are going to increase. But again, that's being broadly expected. When we take a look at where Royal and the rest of the banks are trading at right now, we do think that investors have a very, very optimistic outlook in terms of where credit will perform in 2026. We're not there yet. We still see headwinds in terms of the economic growth, potential headwinds in terms of unemployment levels, and we do think that basically things are probably going to get a little bit worse on credit before they get better. We do think the second half of 2026 will probably be reasonably solid and could then start to see some valuation lift. But we do think there's probably going to be some pressure before we hit that point. And
what are your concerns with the headwinds with economic growth first?
Well, basically, we still do not have any resolution in terms of trade with the U.S. We also have the USMCA agreement being up for negotiation next year, based on the way that Trump and Carney have been not negotiating. You can't say that it's going to be smooth sailing on that. Any disruption on trade is going to cause additional headwinds in terms of economic growth, and then that just ripples through in terms of the credit outlook for the Canadian banks. If we do start to see increase in unemployment levels, that really is the canary in the coal mine for Canadian banks when it comes to credit. And then you could see a dramatic reversal in terms of sentiment. Again, the Canadian banks are very, very well run, very stable operations, but just right now with the valuation set, the balance of probabilities is there's probably more pressure than there is uplift.
Have you ever had a time where you had no buy ratings on any of the banks?
Not that I can recall. This is not a very comfortable position for me at this stage in the game. But that being said, when we look at the outlook for the Canadian banks versus some of the other sectors that we cover, like the insurers, they're not as stretched in terms of valuation, and as well, generally speaking, the life cos have more exposure outside of Canada than they do in. And our outlook is that Canada is probably going to face more macroeconomic pressure than the U.S. and maybe broader in the world.
And looking ahead, what might convince you to change to buy again?
Yeah, well, it would actually be basically stronger economic growth is really the key fundamental that we're looking for right now. That growth can hide a whole bunch of ills. It can even offset maybe an uptick on unemployment levels. But right now, we're just not convinced that we're going to see that acceleration in the near term. As well, the one thing that we're a little bit disappointed with the Canadian banks wholesale is return of capital to shareholders. They have exceptionally strong capital levels, and even though I'm concerned about the relative outlook for the macroeconomic environment, we do think that they're overcapitalized, and we would much rather see stronger shareholder buybacks in terms of lifting not just the EPS but also be accretive to ROE.
Okay, and just one last question. Any names to watch?
For the quarter in particular, we recommend that investors focus on National Bank. Management has stated they are planning on giving us some estimates in terms of the additional synergies that they're going to get from the Canadian Western Bank integration. But more importantly, as they migrate Canadian Western Bank's portfolios onto their own, they're going to get capital relief. And we do believe that most, if not all, of that capital is going to return to shareholders eventually over the next 12 to 18 months. That will be definitely a positive catalyst for sentiment on National.
Okay, we'll leave it on that note there. John, thanks very much for joining us.
Thank you.
John Aiken is research analyst at Jefferies LLC.